we're talking all about how you can accelerate depreciation on a rental property, which could result in well over $100,000 in losses this year to reduce your taxable income. You do not want to miss today's episode. If it's your first time here, my name is John Boyd. I'm a certified financial planner. I'm the founder and lead wealth advisor at Modern Wealth. That's modern spelt with no vowels, wealth. We're a fiduciary fee-only financial planning firm located in Scottsdale, Arizona, but we serve clients all over the country. I am so glad that you're here today because we got a good one for you today. So if you have a rental property, it is absolutely critical that you understand these two concepts. And these two concepts are bonus depreciation and a cost segregation study. We're going to talk about both of them today and how they could potentially save you thousands of dollars in tax savings this year. So in order to understand today's episode, if you do not understand the basics of rental property depreciation, I need you to go back and watch our video on rental property depreciation. Go watch it and then come right back to this spot in the video. So assuming that you understand the basics of rental property depreciation and we're talking about a residential property in today's video, let's assume that you purchased a property for $500,000. So your cost basis is $500,000. Let's assume that of that $500,000, 25% is considered non-depreciable land. The rest of it that we can depreciate depreciates over a 27.5-year period of time down to zero. So our depreciation would look something like this. So we have our total basis of $500,000, the land value at 25%, which means our depreciable basis in the property is $375,000. Divide that by 27.5, and our annual depreciation is $13,636. Now, depreciation is the reason why most rental properties are technically at a loss for tax purposes. And because they're operating at a loss, you could potentially use those losses to offset other forms of income that you have. But here's the thing, right? After you factor in your income from the property and the depreciation, your losses might only be a couple $1,000, right? That might not move the needle a whole lot in terms of tax savings for you. But what if there was a way that we could unlock more of that depreciation, right? That depreciable basis of $375,000. What if there was a way that we could tap more of that now to accelerate our depreciation and create more losses for tax purposes? Well, let's take a look at depreciation a little bit differently this time. So same property, $500,000 cost basis, 25% in non-depreciable land. But this time you're going to notice that the 27.5-year property is only 50%. So let's break this all down. When you look at your property, in reality, not every single component is going to depreciate at the same time, right? Your roof is not going to depreciate at the same level as, let's say, your gas stove in your house. The IRS understands this. And so the IRS allows you to classify different components of the property with either a 5-year, 7-year, 15-year, or 27.5-year classification for a residential property. And the reason why they allow these different classifications is they understand that not everything is going to depreciate on a 27.5-year linear basis. So for example, maybe the roof, the walls, the foundation of the house itself, that will depreciate over a 27.5-year basis, right? But let's say the gas stove, the dishwasher, light fixtures, etc., those type of items are going to depreciate over a 5-year span. And then something like, let's say, your asphalt driveway will depreciate over a 15-year span. So when you break this all down, you're going to see that not everything depreciates in that 27.5-year category. So why does this matter? So this is where bonus depreciation comes into play. As part of the Tax Cut and Jobs Act, the IRS allows you to take accelerated depreciation. In other words, they allow you to take the depreciation of assets that have a 20-year or less life They allow you to take all that depreciation in year one. So rather than spread it out over a 5-year or 15-year span, they allow you to take it all and jam it into year one so that you could accelerate the depreciation. And this accelerated depreciation could result in accelerated losses, which could, in theory, reduce your taxable income pretty significantly. But keep in mind, with this accelerated depreciation, it is currently being phased out. So starting in 2023, rather than being able to take 100% accelerated depreciation, it is now phased out to 80%. So please keep that in mind. But as you will see here, roughly 25% of our basis is 20-year or less property. So let's take a look at how much depreciation this gets us. So again, our basis here is $500,000. Non-depreciable land, right? We can't do anything with the land, is $125,000. We determined that $250,000 of that basis is 27.5-year property. So things like the wall, roof, etc. And then $125,000 is 20-year or less property. We saw that 20% was 5-year property, and then 5% was 15-year property. So what we are going to do is we are going to take 80% of that $125,000 figure for the 20-year or less category. We're going to take 80% of that, and that gives us $100,000 in bonus depreciation in 2023. We also can take our depreciation from our 27.5-year property. $250,000 divided by 27.5, that gives us $9,090, which results in $109,090 in depreciation in 2023. If you play your cards right, that's potentially over $100,000 in losses that you could use to offset W-2 income and other forms of income. But the million-dollar question is, how do you determine that, right? How do you determine what components of this property are 5-year, 7-year, 15-year, 27.5-year? Like, how do you figure that out? Well, you could, in theory, go around your house with a clipboard and try to do it yourself, but that's probably not going to hold up with the IRS very well. So this is where a cost segregation study comes into play. A cost segregation study is when you hire a firm. Typically, these firms are comprised of engineers and CPAs. And what these firms go ahead and do is they go to your property and they conduct a study. And when they conduct this study, they go around, they take pictures of the house, they go ahead and take a look at all the different components of it, from the dishwasher, from the washer dryer, light fixtures, cabinets, etc. They go ahead and break it all down, and they write down which is which, right? What is 5-year property? What is 15-year property? What is non-depreciable basis, right? They break it all down for you. And so what you are looking at here is the post results of this theoretical cost segregation study that we did, right? We didn't just pull these numbers out of thin air. We had professionals come into the property and actually conduct a cost segregation study to determine all this for us. Number one, the IRS requires that this be done. Number two, this gives you a significant amount of audit protection. It's also not free, so you need to factor that in to the economics of this decision on whether it makes sense to pursue bonus depreciation in a cost segregation study. Generally range from around $5,000 to $10,000 depending on the firm that you go with and the area that you live in. But as you just saw, right, if we conducted that cost segregation study and we made this determination, this would allow us to potentially accelerate those losses in year one, which could result in pretty significant tax savings. The other side note that I'll make is that once you do the cost segregation study and you want to take advantage of bonus depreciation, it will require you to file a tax form to change your accounting method on that property. So keep that in mind that you're not all the way done yet, even after you do the cost segregation study. So now that you understand what bonus depreciation is and the benefits of a cost segregation study, what are the 3 big tips that I have for you? Well, number one, be aware of recapture, right? If you watched our other video on the basics of rental property depreciation, you understand that it is not a free lunch. So if you go ahead and do bonus depreciation in year one and you sell the property several years later, you will have to recapture that at some point. So you need to keep that in the back of your mind from a planning standpoint. However, if you play your cards right here, there are ways where you could potentially defer the gain and the recapture with something like a 1031 exchange. So again, there's additional opportunities for tax planning later on down the road, but you do need to be aware that you'll have to come up with a game plan for recapture. So number two, this is probably the biggest consideration that I have for you. So please, if you do not get anything out of this video, please keep this in mind. You need to be aware on whether the losses from the property will be active or passive. Generally speaking, not always. There are cases where it can make sense to do it when it's passive. But generally speaking, doing a cost segregation study and taking advantage of bonus depreciation, it doesn't make a whole lot of sense most of the time unless you can actually take that depreciation in year one and use it to offset your earned income, right? So if you're making $500,000 from a job and you need to find ways to reduce your taxable income, well, this could be a way that you could potentially do it. But if your property is just a purely passive investment in the eyes of the IRS, even if you go through all these steps to accelerate depreciation, you aren't going to be able to take all that depreciation and offset your ordinary income. The end result is you'll end up with lots of carry forward losses to offset other forms of passive income that you have, and you'll just be dealing with more recapture issues down the road. So you'll want to keep that in mind. My third and final tip for you is consider what your taxable income is. Even if the stars align to make this strategy happen, even if you're really excited to take advantage of doing a cost segregation study and taking advantage of bonus depreciation, if you have very low taxable income, then it might not make sense to deploy this, right? Because again, this isn't cheap, right? It is not cheap to do a cost segregation study. So if you're going to fork up all the money on a cost segregation study, take advantage of bonus depreciation, and you're in a really low tax bracket to begin with, well, maybe it doesn't make a whole lot of sense to do it, right? Maybe that we should pursue other tax planning opportunities. But there you have it, guys. You can now see the benefits of bonus depreciation and deploying a cost segregation study and how it could potentially save you thousands of dollars in taxes. If you need help doing tax planning around this, right? This is literally what I do for a lot of our clients. We weigh the pros and cons of strategies like this. We model it all out and we see if it makes sense to deploy for their financial plan. So if you need this type of planning, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. I hope you learned a thing or two and I look forward to hearing from you soon. Talk soon, guys. Take care.